let's get started. So, good morning and a very, very happy New Year to everyone. Thanks for joining. And like I promised, I think we've been doing this for the last couple of quarters. Uh, we'll do a basic overview of what has happened, what is the expectations, and then we'll do a Q&A. First things first, obviously, uh, we're not ideally we're not going to talk about any specific stocks. Uh, but whatever we discuss today is more, you know, basically, these are all our thoughts, not recommendations to buy or sell any particular stock. I'll leave the disclaimer on the screen for a few seconds, and then we move on. Interestingly, I think this is so. Like I said, we're starting off a new year. So happy New Year to all of you. Uh, I'm hoping, wishing that everyone has great health, wealth, and happiness in this calendar year. How did 2025 go? Right. Obviously, in for the markets in India, it was not very good. If you see across the world, I think India was one of the worst performers in terms of large economies. Uh, there were countries, I think South Korea was the best performing. You can see here Brazil doing extremely well, South Africa doing extremely well. Europe overall did very well. Uh, UK, Germany, France, Japan, Singapore, Hong Kong, pretty much a large part of the developed world uh, did fairly well. And even within the emerging markets basket, we were, the worst performer. Now, one of the main reasons for this is that we continue to see relentless selling from foreign institutions uh, throughout the year. I think first couple of months, I think April, May would have been positive, but subsequent to that, the second half of the year was just constant selling, as you can see here. Uh, Excluding the month of October, I think every month there was constant selling. It was balanced to a great degree by domestic inflows, whether through mutual funds, pension funds, insurance, EPF, etc. Uh, but uh, I'll talk about it a bit later as well. But there has been a significant amount of uh, money that is being diverted to the primary markets, which also led to a kind of lackluster market for India. Sovereign wealth funds. If you see, this is a first year where investment went below $10 billion in the last 5-6 years. So sovereign wealth funds also sort of took their foot off the pedal. And if you see mutual funds, right? It's very interesting data points here. This is not the net, cash inflow or outflow, but this is what is happening at the folio level, right? So, number of folios that are seeing active fund infusion, and if we start seeing that, right from the peak of the market, it is starting to fall. So, roughly about July, August last year was when the market. Year before last, 2024, is where the market peaked. And then if you see, there's been a sharp drop. So basically, just saying that when the market goes into a fall, you find a lot of participants going out of the market. And that is also another big challenge for the long term, because what happens is the whole idea of doing SIPs or being in the market is that you benefit from the time period when things are not going well, because this is the time when you're if you're putting in capital, you sort of tend to be able to buy more stock, and then that pays off when the market recovers. This is more true in the mutual fund space, because there you're not taking stock specific calls, right? So but what we see here is that investor appetite of investing into equity funds start reducing when the markets go down. And here you see that the interest in gold continues to go up. So this is a very classical case of FOMO or momentum or trend following, whatever you call it. So momentum, trend following, these are inherent in human nature. Excuse me. Uh, then this is another very interesting data point, is that the number of stocks that we saw in last year where there was significant drawdown. This is part of the Nifty 500 basket, and this is one of the key reasons. A lot of people, think that markets, as in Nifty, is at nearly at an all-time high back again. So why is my portfolio not, nearly back to the all-time highs? And one of the main reasons for this is that an overwhelming amount or percentage of stocks are there where where they are still far below the 52-week highs, and that is why you will find that most portfolios are still bleeding, yet Nifty is close to an all-time high, simply because Nifty is very concentrated in a few mega caps. This is another very, very interesting data point, and what we saw last year was uh, huge number. I think there were about 387, if I'm not mistaken, IPOs on the main board last year. I could be wrong by a few here and there, 387, 389 or something like that. But huge number of IPOs. And if you, I think there's a mistake here uh, in the numbers. The issue size is not 16 crores for Tata Capital for sure. But basically, these are the large IPOs, uh, in descending order, the top 10, 15. And we saw very, very large, prominent companies come to the market. So Tata Capital, HDB Financial Services, LG Electronics, ICICI Prudential, AMC, Hexaware. So for Hexaware, this is the second coming. So people who have been in the markets for long, they'll know that Hexaware was listed before they got unlisted. They sort of delisted themselves, and they've now come back again into the market. Lenskart, Grow, Misho, NSDL, Pine Labs, JSW Cement. So a lot of these large companies have come into the market. And here is a very interesting piece of statistics. So what we saw is, of all the companies which went into IPOs, the percentage of stocks which listed in profits. So on day one, on the listing, the opening price, nearly 80% had a profitable opening on listing day. The average listing gains, this is the average, was 9%. By the end of closing on the listing day, from 80, it came down to 67%, right? Number of stocks which were profitable. And within a year, it is below 50%. So these are all stocks which IPO'd in 2025. So not everything, not all stocks have completed a year. Some may have completed a few months. So between 1 month to 12 months. But what we see here is that less than 50% stocks remain profitable, within a year. But what is happening is that there is a very large number of people who are playing this IPO pop game. So they are applying, they are serial, appliers to IPOs for this, playing this 80% listing, uh, you know, so 80% of the stocks listing in the positive. So that is the game a lot of people are playing. And whenever we see very large IPOs coming into the market, what we also see is that there is money taken out of the secondary market, and some of it, or nearly probably all of it, goes channels gets channeled back to these IPOs. And uh, you know, to my mind, I think that also uh, provides or proves to be a dampener for stocks in the secondary market. Now, one of the results of a lot more companies coming for an IPO is that our market cap to GDP has started increasing significantly, although the market cap has not really gone up, right? So, market cap of the previously listed companies have not gone up. Most of the addition is coming from companies which are getting listed. And if you see for comparison here, US market cap to GDP is about 20 to 13%. Japan is 157%, and Germany and China are very, very low. And so the natural question could be that why is Germany and China so low? Uh, because they are, much, larger, uh, big countries, big industrial bases. Why are their market cap to GDP so low? And it is basically because of the nature of the corporations that are there. So in Germany, there are a lot of these private, large, family-owned businesses that are there. Same for China. China, more of government, large businesses which are unlisted, and that is one of the main reasons why they don't show up in the market cap calculation in the numerator. Now coming to overall earnings, and here from here on the tone gets slightly somber, because earnings growth, what we see in Q2, we are already in the earnings season. We've started seeing some earnings come through in Q3, but this is for the published, the aggregate data for Q2. And here what we see is that PAT growth is just about 6%. And if you see, it's, although it's sort of, uh, you know, it's not good in is what my point is. And if you see again, sales growth very, very low, 5% growth, and it's pretty much the same that was there a year before. So overall, what we are seeing is that earnings growth is not coming through, right? And that is what is impacting our investing today. And this is again a very interesting study. Is, if you see large caps, mid caps, and small caps, segregated, and the study has been done over a period of time, uh, between, so all these phases have taken from 2003 to 2008. This was a bull phase. What has happened? Then, every phase you see what has happened, you will find that mid and small cap. So Sensex is the large cap, is the mid cap, and the small cap, right? You'll see the percentage returns, and you see that in bull markets, when things are good, small caps tend to outperform large caps, small and mid caps. But conversely, when markets are going down, I think, and this is intuitively understood as well, large caps tend to hold up much better. And this is understood again. This is more pronounced in this phase of the market between 2010 and 2013, when small caps sort of corrected more than 50%, whereas large caps was down only 14%. Similarly, again, if you see in this phase between 18 and 20, again, there was a very large differential. But if you see in this entire period, right from the beginning till the end, and across any cycle, you will find that uh, you are probably better off being in a combination of mid and small caps if you are trying to create wealth for yourselves. And if you're trying to preserve wealth, then you are probably better off in large caps. So that's I think good data points to just reinforce the idea that we already probably are all aware of, is that mid and small caps tend to give better returns over cycles. And here again is a very, very interesting, data point which tells you, based on factor investing, right? Whether you're talking about momentum, value, growth, quality, low volatility. If you played individually each of these factors over the last 10 years, how would you be placed? So you will find that there is not a single factor which is consistently doing very well. So here on the top, you'll find probably value doing well in 22, 23, and doing well last year. You will find momentum doing well in 19, 21, and 24. Growth doing well in 2017 and 2015. But what we have to see is there are two things. One is obviously the 10-year CAGR, and here you find that obviously momentum tends to do the best and significantly better than the others. Then you have value here, growth here, growth and quality sort of pretty much around the same thing. But what I think is more important is if you just look at the top two rows here and you see which colors are more, which colors are there which are coming more repeatedly, right? And intuitively, you will find that it is basically momentum and maybe growth. So one, two, three, four, five boxes of growth. And how many? One, two, three, four boxes of value, right? Momentum obviously is probably the highest. One, two, three, four, five, six, seven. So the point here is, although it shows here that momentum obviously is doing the best in both these counts, but on a CAGR basis, although growth is lacking behind value, what you will find is that growth actually does better uh, over on more periods. Now, one of the reasons why you will find probably growth uh, uh, not doing so well is when it does underperform, it sort of gives you more negative returns, whereas probably value is going to be around somewhere here. Okay. So again, the takeaway from this is that if you have a long-term horizon, you are probably better off, looking at momentum, value, and growth as styles, or a combination of some of these factors as styles as part of strategies that you want to deploy. And luckily for me, these are the main areas that I tend to sort of focus on. Okay, now more importantly, how are we currently poised, right? That I think is very, that's the more important part. Obviously, we are seeing probably a generational shift. This is not a decadal shift. I think this is a generational shift that we are seeing. Uh, I was pretty young when we saw the fall of the Berlin Wall and Berlin Wall and uh, the sort of end to the Cold War. Now we are seeing again a time when uh, peace is taking a back seat, and we are probably we have already got into, and my sense is we are going to get into much more wars, skirmishes, more towards a more violent geopolitical future is what we are looking at. Every country in Western Europe, in US, are they are talking about increasing their budget for defense. The nature of defense spending is completely changing in front of our eyes, from men, uh, artillery, missiles. We are seeing now a lot more focus on electronic warfare. We are seeing more of drone-based warfare. Uh, my sense is going forward, we will see more of cutting edge technology getting deployed. We are all hearing of how sonic bombs, etc., were used in the Venezuela incident. Uh, so more of those things, bio weapons, etc., getting used more and more in the future. I think that's the direction of violence that's going to take, and obviously the the establishments across the world, the governments, they will have to take countermeasures and uh, beef up spending. So the more we spend on war, the more uh, resources, the less resources we have to spend on development, on growth. So that is something that we, as citizens of the world, will have to sort of take into account. Uh, One good part that we are seeing is that India is slowly realizing that without manufacturing, you cannot survive uh, in this kind of a geopolitical scenario. I think every country is realizing this. Uh, I think US has realized this, and that is one of the key reasons why we see President Trump doing what he's doing. I mean, uh, people may not agree with the way he's doing it, but ultimately, I think uh, he's trying to bring back manufacturing back to the US. Whether that's going to be successful or not, whether his way of doing it is right or wrong, that's a completely different discussion. But the fact is that uh, to be powerful, you definitely need to be able to manufacture goods and services uh, that that is critical for the country. And India, we've got this Atmanirbhar program, and I'm not going to claim that it's already doing great, but at least it's a step forward. India is a country where we sort of, historically, post independence, I think we've sort of muddled along the way. We tend to disappoint both the optimists and the pessimists, and that's the way it is. And I think manufacturing is something that India is now already beginning to focus on. Whether we end up being a major superpower is something in manufacturing is something that we have to sort of wait and see. But definitely there is traction. There is things which are already beginning to happen on the ground. We already saw how uh, electronics, from being a net importer, we've now sort of turned around and become net exporters. Uh, though primarily on the back of iPhone exports, but nevertheless, it always starts this way. People tend to forget. A lot of people complain that we are not doing too much value addition in iPhone exports. Uh, my counter to them is the entire IT industry started off in the early 90s being body shopping companies, right? You're just hiring Indian talent and shipping them abroad on a hourly rate, and that is how it started. The main important point is it creates a critical mass of people, it creates the ecosystem, and then slowly you start adding value. China did not become value additive on day one. It took 2.5 decades for them to get to where they are today. The other good thing that we are seeing is that we are now looking at Indian corporates with some of the best balance sheet quality over the last decade. I think if you see this chart, is very interesting. Uh, the net debt to equity has fallen drastically over the last 10 years, and that bodes well actually for the country. And if you look at the engines of growth overall in an economy, ultimately there are three main engines of growth. It is either the government who can spend, it is the corporates who can spend, or it is the households who can spend. For top-notch growth, you need all three to fire. At any point in time, if you have any two of these firing, then you have decent growth. And there are times like, say, the last year and a half, where the only sort of spending that is happening is from the government side. Households and corporates have sort of not spent. Uh, that is when you have this kind of tepid economic scenario. and the entire economic machinery think tank, the objective is to get all these three cylinders firing. uh, like I said, it is government, corporate, and households spending which matters. And here we see that pretty much for 14, 10, 12 years we've seen flat growth. Flat capex from the corporates, and it is starting to inch up, right? 2024, 25, it's starting to inch up. And one of the reasons which I believe why Indian corporates are very skeptical of spending is institutions have very long memories, and people who've been around in the 2003 to 2007 8 cycle, you'll remember that that was the time when there was huge corporate capex. You're seeing ultra mega power projects and whatnot coming up, and all of those companies then faced extreme challenges. A lot of those companies actually went bankrupt. You look at, uh, say, the Anil Ambani group. That was one of the corporates who were spending left, right, and center in that period. A lot of those companies have struggled, have nearly gone bankrupt just because they took on a lot of debt, put in capex on the ground, and in front of their eyes, the demand vanished. And that has made corporates very, very skeptical. So I think corporates are looking at capacity utilizations going up beyond 80, 82%, 85% before they start doing capex. And that has not happened over the last decade. Our aggregate capacity utilization still lies somewhere between 70 to 75%. uh, and that is one of the main reasons why corporate capex is not coming up. Although interest rates have been brought down, and uh, corporate tax cuts were given, etc. So many things were done, but still corporate capex did not happen. I think is primarily because of the fact that people were sort of once bitten, twice shy, uh, on based on their previous experience. But the good part here is that we are now starting to see the initial movements of capex coming back. The other small, fast moving data items that I collected, one was that we are, after many years, we are seeing a fresh uh, growth in telecoms subscribers, the total number of subscribers, and that sort of again bodes well. And most importantly, I think the Manrega program in terms of payouts is shrinking, and that is, I think, probably one of the best indicators of rural wage growth and rural distress. So whenever you see this spike, this is the COVID year where people lost a lot of formal jobs, etc. Uh, Formal, informal, both. So people had to sort of go back to their farms and take up take up agricultural work, uh, or work that was available to them through the Manrega program. So again, this is something which is actually a good indicator, uh, in the negative sense that because it is coming down, it shows that there are less people who are willing to work for uh, the 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 base level program for them. So it's likely that they are getting better paid jobs elsewhere. And very, very importantly, I think, excluding if you look at the 2000-2001 period, and this is a log chart of annual log chart. So every bar here basically is 1 year. You'll find that other than these 2 years, in the last 25 years, we've never had two consecutive years where the market was down, and that sort of gives some amount of solace that we've seen a rough year and a half, right from about August, September 2024, and the challenge continues even today. Markets are extremely volatile, uh, but the hope is that we will not see a very bad year this year as well. With that, let me sort of conclude my presentation and go back to questions and answers. And let me, where's my this thing? Okay. So let's see. Let me see if I have any questions. So if there are any questions, you can either put them in the chat box or you can unmute yourself and ask. Okay. Sunny Kumar, you please unmute yourself and ask.
Hi, boss sir, good morning.
Good
Sir, how
morning.
do you see commodity cycle is going on now?
Commodity cycle. See, this it is a very tough question to answer, to be very honest, because uh, apparently what is happening geopolitically, see, is that there is a lot of uncertainty. That's the bottom line, right? You don't know what the US president is going to do. You don't know what is going to what China is going to do, and that is creating the uncertainty, which is what is leading to a flight to real assets. So you will see probably in the next few years, uh, people or investors, large investors, move towards real assets like metals, whether it is gold, silver, etc., uh, to real estate, land, non-precious metals. Uh, so anything that people can touch and feel, I think that is where people are going to move to. Now, on the same note, if you see uh, things like gold and silver, okay, we've had a very, very uh, large, quick rally uh, in silver, especially, right? Now, to me, the narrative that is getting created about silver is so much of growth is going to come from solar panels and industrial use, etc., etc. Now, the point is that all that requirement was there even a year back. So why did it not rally before? Right? And every silver rally that you see in the past, you've had these kinds of narratives. So I think what has changed is that there is genuinely a need for people to in move away from uh, dollar based uh, you know dollar based commodities, if I may put it that way. Gold and silver is actually gold definitely is going up because of sustained buying by central banks across the world. Excuse me, I've got a bad cold. In Calcutta, we've seen this very large, fluctuation of temperature. Uh, Till day before yesterday, it was quite cold. Yesterday onwards, I think it's been not cold, not that cold. So bad situation.
No
Anyway,
problem.
coming back to what I was saying is so very difficult call to make whether you know gold silver the rally has come to an end. My sense is that the super fast growth has come to an end. It will probably still go higher from here, but we may see a correction, uh, and we may see some consolidation, etc. And maybe the fast rise part may be done at least for a while, and then we can see higher levels over the next year, 2 years, but maybe the rate of change is going to be lower. uh, Other than metals, if you are talking about other commodities like sugar, paper, cement, etc., these are all agro industrial products, depends completely on their own cycles. So I don't think there is any sustained rally or sustained demand supply mismatch uh, globally in any one of them.
Same thing will applicable on copper, aluminum,
I think
zinc.
all of them, right? See, the problem is that copper, aluminum, zinc, nickel, everything, people now it is getting into that FOMO kind of trade, right? Everywhere you go, every WhatsApp group, everybody is only talking about silver. People are talking about copper. Uh, but if you really, think about it, has the copper demand really changed a year back and now? It has not, right? Uh, so what will explain this kind of a FOMO and people buying? So obviously, if a million people decide tomorrow morning to go and start buying copper, obviously the prices are going to go up, and that is the nature of momentum, right? Uh, but is there a fundamental driver to it right now? I think the only fundamental driver is that there is a shift away from financial assets to real assets, and that might be the change that is going to sustain for the next 2 3 years, or at least till President Trump is around.
Okay, sir. Thank you so much.
Okay, so let me take a few more questions. Next question is from Shomodip Pal. Is there fundamental momentum in the run up in silver that is underway? Very little actually. Like I said, the actual change in use of silver has not changed in the last 1 year or last 2 years, right? People are saying we are making much more solar panels, etc. But the efficiency and the quantity required in solar panels also has gone down, and it is going to continue to go down because that is the direction of R&D that is being taken. So obviously there is not too much of industrial use, but yes, silver, like its elder brother gold, has some value in terms of being a precious metal, being a store of value. Very interestingly, other thing that has happened is RBI recently has, I think, given a directive that other than gold, you can also have silver loans, right? So once that happens, once that picks up, it sort of opens up uh, one more reason for retail to, at least retail Indian, to buy gold. Sorry, buy silver. So these are also, I mean, in a sense, these are also fundamental reasons, but less industrial reasons, more of this flight to safety, flight away from financial to real assets is what gold, silver, etc. is playing into. Next question is from Gaurang. How can allocate to fund in other assets? So there are mutual funds, there are index funds for gold and silver. You can put money in those. I don't know. I don't think there is any, copper, nickel, etc. But you can play it through some companies that are there. Not the best and most efficient way of doing it. And the reason being that, when you are buying a company which is producing a particular, say, metal, you have to take into account the efficiency of that company, the corporate governance, etc. That goes with it. So you have basically two components that you have to look at. One is the rise and fall of these the metal prices, and the company that you're investing in. Uh, the other challenge is that last 25 years that I've been in the markets, this is not the first time all these metals are going up. What I've seen before is that one fine morning you will suddenly see that metal prices crashing, and the narrative will still continue to remain very strong. And by the time the narrative changes, you will be down 50% on some of these names. And that is the challenge of investing in these kinds of stocks, or these kinds of metals, or these kinds of commodities, because there is no underlying cash flow. It is the price fluctuation is entirely dependent on demand and supply and speculation. So that is the big challenge that I have seen in the past. I don't know how and when that will get replicated, but my sense is at some point in time it will get replicated once more. Next question is from Raj Madhur. given the recent increase in the prices of gold and silver, does it make sense to park a certain percentage of funds in gold and silver? So this is exactly the point I'm trying to make. So right now it is becoming a FOMO trade. Now everybody is only thinking about putting money in gold and silver, and my sense has always been that whenever you find something, whenever you find a asset class or a stock that everybody wants to buy, it is better that you are, you stay away from that and you buy something which people are not talking about, because that is what is going to be available, in a more reasonable valuation. And if you are able to hold on for a year, 2 years, 3 years, you are actually going to make more money in that. So that's probably what is a more contrarian mean reversion kind of a play. Right now I think gold and silver is a lot of momentum, a lot of froth. uh, my sense is that we could see a correction. Whether it will happen or not, I don't know. uh, Whether gold and silver will double from here, I don't know. uh, for most Indian households, I think they already have exposure to gold, in the form of jewelry. Whether you want to make it a form of investment is a call that you want to take. uh, you can have a little, a small percentage, 5-7% into gold, silver, etc. For example, in the ETF small case on the ETF basket that we have gold and silver that we've put in addition to some of the other broad-based indices, and that is one of the reasons why the ETF basket has been performing so well over the uh, last few months. So, short answer to your question is, you yes, you can put in a little bit, but do not expect that it will double in the next 6 months or 1 year. If you want, you can have a tactical allocation to gold and silver, but you will have to be constantly on it, in terms of if you want to put in money as a trade or as a you know more as a speculation that you want to get in, make some money, and then get out. Okay, before we get into the next questions, I think Ritin, you've raised your hand for a while. You can go ahead
Yes,
and
sir.
ask
Thank
your
you.
question.
Thank you for the session, sir. Just wanted to get a sense, from you. Where do you see? You mentioned that we should look at sectors, which are which no one is looking at, or given the questions are all about mostly about gold, silver. So going forward, where do you see where which sectors we should look at? Where earnings can be good and with reasonable valuation. So apart from defense, which seems like a decade-long geopolitical sector, apart from that, where can one look for some growth and nice valuations? Yeah, that's the question.
So, great question. I think, see, one very important point that we have to still remember is that uh, large parts of the Indian market is not cheap, right? And that is one of the reasons why I am still not very comfortable uh, with the markets. Typically, when a bear market ends, you get very very juicy valuations. You get single digit P's, uh, and you don't get people who are willing to buy. We are not anywhere close to it. So we've not seen a bear market in the last 1.5 years. So people who've come to the market, say post COVID, this is the first time you are seeing a drawdown. Now, to me, this has been a very brutal drawdown, but it is not a bear market per se, in the sense that in actual, in long deep bear markets, we see at the end of the bear market, the valuations tend to become very, very cheap, which has not happened here, right? There is ample liquidity that is flowing into the markets. Valuations uh, for the large caps, I would say, is at the median level. For mid and small caps, it's still above median level, right? Uh, so that's the one part about valuations. The other is, where do we see opportunities of growth? Like Ritin, you mentioned, defense definitely is a very very good area for the next decade. Now, within defense, the problem is that, again, you will find most of the companies are valued very very well. So there are two ways you make money over a very long period of time. uh, Very very simplistically, you need earnings growth and you need PE re-rating, right? That is the way you will get big multibaggers. And for the defense companies, earnings growth is what needs to drive uh, the growth from here on. So if we get 30-40% growth in companies, that is where we have to look for. Because P already is nearly double that of the
50,
Nifty.
50 above, or easily
So
for all.
so I
Yeah,
see, my way of looking at valuations is not to look at
absolutely.
absolute valuations. I
Yeah,
tend to look at multiples of Nifty or NSE 500. So let's look at Nifty per se. So now you will probably see most defense companies at between 2 to 3 times of Nifty valuations.
right.
Right? If Nifty is around 220, 21 PE, roughly every defense company or any company which has named itself as defense is between 40, 60 and 80 PE.
Right.
So from here on, unless they are able to grow uh, very fast, their ability to increase their PE is going to be very, very limited. So if a company at 40, 50, 60 PE is growing at say 30% every year on year, the PE may not contract, right, till that growth continues, but it will probably not go up either. So you'll end up sort of making the CAGR that the earnings is growing by. If the so in defense, the objective has to be to look for companies which are going to be able to grow at maybe 30, 40, 50, 60, 80, 100%.
Right.
Right. The other areas where I think slowly a play is beginning to open up is where China used to sort of dump the world. So it could be agrochemicals, it could be chemicals, it could be pharma intermediary. In a lot of these areas, it could be steel, it could be aluminum, a lot of these. So what is happening is the Chinese government has now given out a diktat saying that, boss, we are not interested in fighting amongst ourselves
Right.
and doing low end cheap work.
Right.
So I don't want steel companies fighting amongst themselves to produce the cheapest quality of steel or the cheapest steel in the world. And that opens up opportunities for other players who are able to step in. China is now trying to get into the space that US is vacating, right? Both geopolitically and industrially. So they are now increasingly, you will find, focusing on high end. So they'll focus on AI, they'll focus on chips, they'll focus on space tech, they'll focus on climate tech. And that is where I think you will see where China is focusing on, where their value addition is going, or the Chinese government subsidy is going to go on. So consequently, what is going to happen is wherever there was Chinese dumping, you have an opportunity. Right. So that is, I think, where we should be looking at. So that is one. Second area is follow the money. I always have this feeling, what do you mean by follow the money? What I mean is, like I said, there are 3 buckets of spending in a country: government, corporate, and households. So just think about where the money has been made. You look at hotels, right? Hotels have gone up because households have spent on vacations post-COVID. So there is a definite money flow that is happening from households to hotels, or hotels, eateries, etc.
High-end discretionary, basically.
High-end discretionary, right? So SUVs getting sold more and more. Similarly, where government has focused on. So we've seen rallies in defense, we've seen rallies in railways, we've seen rallies in whatnot. I mean, airport stocks and airline stocks and whatnot. So follow where the government is spending. So 1st of February, we'll have the budget. Again, you will get an idea where the government is prioritizing. So looking at the last few months, what are the bills that the government is coming out with? You're focusing on nuclear power, the Shanti bill. We are focusing on shipping, dredging, etc. We are focusing on roads. We are focusing on railway safety. So these are areas where the government is willing to put their money where the mouth is. So that is another basket. Then the last part is where look at where the corporate is spending. Where is the corporate spending? Corporate spending is coming where PLI schemes are there, right? Somebody is giving me a subsidy, I'm going and putting in a factory there.
Right.
So
Incentive. Yeah.
in wherever the corporate is getting an incentive. So where are they getting incentives? In electronics manufacturing. And you see all the EMS stocks have, what they have done over the last 4-5 years.
Right.
So in a nutshell, follow the money, see where the government is focusing, where the households are focusing, where the corporate is focusing. And that is where the medium to long term money is going to be made.
Got it, sir. Thank you. Thank you for the answer. Thank you, sir. I appreciate it.
See, where is the next question? Okay, next question is from Binu. Good morning. Could you start updating the investment reports with how the thesis is playing out over time? Today, there is no way to understand how the individual companies in the portfolio is shaping up. Yeah, good suggestion. What we can, what we used to do, still keep doing is, send out quarterly updates based on how the companies are doing. What I have seen, and this is now a sort of toss-up between, I was actually thinking of stopping doing this because I don't know whether it actually is adding any value. Because nowadays, when I started doing this, it was because it was a way for me to collate all the key points of the con calls in one place. Today, all of this is one click away. Screener puts it in AI summaries. So whether it is meaningful or not, I am not very sure. How the thesis is playing out is something that we keep tracking every month, every quarter. And whenever there is a major change in the thesis, we actually we make a change in the holding of the stock, whether we add, delete, etc. So that's the way we are doing it currently. But yes, we'll keep this in mind going forward. Next question is from Nilabhro Das. There are quite a few stocks in the portfolio. Don't you think it's going to dilute returns? Why don't we cap the number at 15? So basically, it's a diversification versus concentration debate. So I basically think of the portfolio in two buckets. One is a long-term portfolio, and the other is a tactical short-term kind of a portfolio, which is more of momentum churn, short cycles, etc. Now, for me, reasonable diversification and concentration is holding stocks between 10 to 20. There is no magic in 15 as a number, like you mentioned. There is no magic even in number like 10 and 20. My sense is, if you have 10, you have roughly equated, you have 10% allocation in each. If you have 20, you have 5% allocation. So this is between these two is a reasonable number to have. Sometimes it goes beyond 20 because whenever you are playing a basket bet, right? So for example, if I'm playing shipping as a basket, right, I am more focused on an industry. So I may take, a 1% bet in 5 or 6 stocks. So that makes the number of stocks more, but the concentration or the allocation to that industry remains the same. So that's the way I would tend to look at it. Usually will not go beyond 20. From an allocation perspective, we'll have basically between 10 to 20 buckets, if I may put it that way. Next question is from Manish. The prospects of HBL seem promising. Management too is under promising, over delivering. However, the price action is deteriorating. How do you see the prospects ahead of what is our exit plan if things go south? Okay, good question. So I tend not to speak about individual companies in public forums, and there are two reasons for it. One is, so the most important point is I don't want to bias myself for the future. So for example, if I say that HBL is a great company, it's going to do great, blah, 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 and then it does something stupid, or it does something that I'm not expecting, and I want to get out, the commitment and consistency bias will play in my mind, and I will struggle to sell. So that is one reason why I don't want to take a public, position or a public posture in any stock. You will very rarely see me uh, post anything on Twitter or LinkedIn or social media, or talk about any stocks that we've recommended or that we've bought uh, anywhere. And unlike a lot of other fund managers who uh, they buy a stock and then they start writing about it, I don't do that, because precisely because of this reason. I think that uh, it's going to be harmful. It's going to be psychologically difficult for me to change my mind if I start saying that this company is great and then it turns out not so great. So that's the first part. The second thing is that I don't believe that any company is to be bought and held for forever. So I uh, I've been a very diligent student of Munger and Buffett, but over the years, uh, the reality of investing in an emerging market versus a developed market, and the times have changed, etc., have made me realize that you cannot hold a stock forever. There is no company which continues to deliver forever. And my objective, these whenever we are investing in a company, it is not a uh, it is it's not a strategic investment. I'm not buying 10% of that company. I'm not getting on the board of the company. We are buying positions as minority shareholders, and if and when things change, we want to get out, right? So that's the second part why I don't want to talk about individual companies. Uh, HBL, I think they are doing well. HBL is a company which has seeded a lot of optionalities, right? They are doing covers, they're doing a lot of good defense work. So anything can, one small shoot can actually become a big plant in HPL. Now, having said that, there is not everything which is great about the company. For example, the announcement, the corporate announcement that the company came out with on Thursday night, I found was extremely foolish, right? I mean, why on earth? What kind of virtue signaling are you trying to do by saying that I have not got any orders because my competitors bid lower, right? I, I found it downright stupid, to put it slightly harshly. I have never seen a company come out with a corporate announcement saying that I have not won orders. Who asked you if you not you come and announce if you win orders? Nobody's asking you if you not won orders. Then every company for after every tender will come and say, I had bid, I have not won orders. So these are things which don't sit well with me, because this may indicate some amount of hubris in the management, right? So these are things which go in as inputs. When you are an investor in a company, like we've been an investor in HBL for 2-3 years, I think 3 years or more, right? All of these, the good, the bad, the ugly, everything goes in as inputs, and then you process it, right? Then you see price action, then you see their corporate results, what the management is talking about, what they are delivering, and then you over a period of time take a call and decide when you want to exit or when you want to add and things like that. That's basically about HBL. What is our exit plan? I mean, we'll have to see. I mean, we'll have to see how the company performs, and then we'll decide based on that. The next question is from Ashim. What is your take on geospatial sector as a whole? Sentiment is quite down, and some major sellers have been selling. See, I personally think that geospatial is a sunrise sector. It's a very small sector as of now. So there are maybe 3, 4, 5 players of reasonable size. You have Genesis, you have Censys, and a few unlisted players, and the entire bucket is very small. The other thing is, these are very small cap companies, very illiquid companies. So selling by 1 or 2 big shareholders can make a very big difference in price. I would still continue to observe their corporate results. So when I look at, say, when I'm studying this sector, I watch both Genesis and Censys together, and I'm seeing that they continue to get orders. Their results continue to be good. So let's see how it plays out. I overall, I think I'm still very positive on the sector. We'll have to see how it plays out. Whenever you're investing in very small cap illiquid companies, you'll have to give them more leeway than when you are investing in larger mid caps or large caps, which are much more discovered, where the holding shareholder holding is not so concentrated, etc. Okay, next question is from Yogesh. Your thoughts on impact of AI on Indian IT industry and its in turn impact on consumption and real estate sector in India? Very, very interesting question. I don't know the exact answer to this and how it will play out. One possibility is that, see, there are two things that I'm thinking right now. I'll tell you the way what I'm thinking, and then then leave it at that. So one is that AI is going to need less professionals in these IT companies. So whether it is Infosys, Wipro, TCS, I mean, the entire basket, you will need lesser programmers, lesser coders. So that is number one. Now the second part is that how AI will evolve in the actual enterprise space, right? That's the thing that we have to watch out for. Right now, if you see, AI has not been able to penetrate enterprise all that much. Right now, it is at a retail level. You have Chat GPT and you have Gemini and Claude and all of that and you are using, most people, right, are using it as productivity benefit tools, right? You are asking it to summarize something, you're asking it to write some mundane stuff and things like that. Now, how is that going to translate into, take any example, say a big bank or a retailer, or take any company, and you see that how is it going to affect them as a business? And then you will find that you don't have all these many use cases as of now. So I've been speaking to a friend of mine who leads AI in one of these large IT companies, and maybe I've asked him to come and do a webinar for us. So maybe we'll do it sometime. But the idea is that at the enterprise level, right now it is at a very, very initial stages. Now, over time, you will need AI to be integrated into various tools, applications, etc. Right. So, for example, your net banking may have AI and all of that. Banking backend may have AI inbuilt into it. So, how will that happen? That will need more and more application software being built, which in turn might need more involvement by these Indian IT services companies. So, the short answer to all this long talk is that I don't have a clear-cut answer. The answer is not as simple as saying that the Indian IT industry is going to dwindle down. It is very well possible that it is actually going to increase in size, because we will need much more implementation of AI in applications, in enterprise applications, than So it's like when mobile came, you needed more and more systems built for mobile. So we had this era of mobile first applications. When applications had to be moved to the cloud, same thing happened. Cloud migration projects started taking place. So here now, I think we will now see next couple of years more AI enabled applications getting built. So that's something that we have to see how it impacts the workforce. Having said that, salaries in Indian IT service companies have been stagnating for a long time. And the problem that I see, the big challenge, and you will see that in the last, I think, week, 2 weeks, we are seeing a lot of media discussion on the gig workers and things like that. And it is now slowly getting into a political debate. Now, the challenge why we are seeing all of this is that India is at this, in that phase where we need to generate huge number of jobs, and that is what is missing. And for our generation of people, right, people who are, 40, 50, 60 years old, for our generation, the big part of job creation for the middle class happened through IT. That may not happen for the next generation. So people who are, in college now, people who are less than 30, you know, that is the demography which is going to see challenges. And that is a real concern personally for me, is how as a country will we be able to generate enough jobs to employ the number of people that we have. So it's a very complex problem. I don't envy any of these political parties, policy makers, because it's not a uh, it's not easy problem to solve at all. So I don't know the answer to uh, how the IT industry will look like, uh, and consumption, real estate, especially real estate, has been dependent on IT for the last 25, 30 years. And that is why you see real estate uh, development in primarily the cities where IT has grown, right? You've seen uh, Bangalore, uh, Pune, Hyderabad, Gurgaon, Noida. That is the place where real estate has really sort of gone up. And it's primarily because of IT. What happens if IT do not employ as many people as before? That's an open question, and I think we'll have to keep watching the data to answer that. I don't have an answer to this question, but right now I think I would say that I'm somewhere in between. We could actually see uh, another resurgence of IT services because of AI, although with maybe slightly lesser number of people. Okay, that was a very long answer to a. I don't know whether it made sense or not, but that's the way that I'm thinking. Next question is from. I cannot pronounce your name. I'm extremely sorry. I can probably pronounce your last name, Karkanan. First part is fairly difficult for me to pronounce. Okay, but let me come to the question. Good morning, sir. What is your thought about data center sector? There's nothing to think. I think data centers are continuing to grow. Ultimately, the demand is going to grow more and more. The consumption of data is exponentially going up. I'll tell you the change, a small change. I'll tell you that has happened with me previously. Whenever I used to travel, I used to say 10, 15 years back, I used to carry a separate camera because mobile phones do not have a camera, or not a good one at that. Excuse me. So I should take photos of that and upload it, or save it in an external hard drive and stuff like that. Slowly, it moved to a mobile camera. I am not a very good photographer, so I don't have all of these big cameras that people lug around with. So my entire photography is on my very basic mobile camera. And over the last 3 years, what I realized was that when I'm looking at photos, I am not able to recollect exactly what happened when I was there at that point in time. So what I started doing was I started taking very short videos, 40 seconds, 50 seconds, 1 minute, 1.5 minutes, and more like a personal vlog, right? So wherever I now travel, I do this. And what I found is that whenever I'm looking back, it sort of completely refreshes my memory. I know when I'm recording, I just say, this is the time, this is the day of the week. I am here, I'm doing this. This is what happened. I came here this way, blah blah blah, in that short video, and I then look around the place, etc. Now, why I'm telling you all this is my own personal data consumption or data storage requirement went from a few MB uh, in photos to now storing videos, short form videos in uh, for every vacation or every place I go to. So probably my data storage requirement has gone up 100 to 1000x, and I'm sure that over time this is going to happen to most people. I mean, may not be this specific example, but uh, consumption of content, movies, everything. So more and more data is going to get required. So more and more data centers, you will get more and more requirements for data localization. So more and more data centers in country. So data centers is going to remain a sector that is going to uh, do well, hopefully, for the next few years. Okay, next question is from V Haldar. Hi Abhishek, would love to hear your views about the risk of oral GLP pills with respect to injectable GLP device and medicine manufacturers, especially in next 2-3 years time frame for the Brazil, India, Canada market. So obviously, uh, I've been very very closely observing GLP-1. One, because I think I mentioned this many times before. I have been losing the battle of the bulge for the last 25 years. I've been trying to lose weight. It's not happening. And so I am very keen that maybe I should try it, but I'm very scared of needles. So I'm very scared of injectables. So I'm waiting for a good oral pill if it comes. And I'm also waiting for some period of time to go when you have a lot of people taking it, so you get some anecdotal evidence of how what the reactions are and things like that. So that's where personally I am. So and that is one of the reasons why I watch this and study this space study this segment very closely. And the one thing I can say is there's so much of research going on in this segment that is very very difficult, practically impossible to talk about what is going to happen in 2-3 years time frame, right? Or for is a oral GLP-1. It's shown good results. May not be as good as say Ribolisus. I mean, no, not Ribolisus. In fact, it's shown much better results than Ribolisus, but may not be as good as the current injectables. But over time, if there is a lot of convenience on an oral pill, then it might be more acceptable. Now, last week I saw China coming out with a pill with and an injectable, sorry, not a pill, an injectable which is going to be which needs to be injected fortnightly. So now you're reducing the frequency from once a week to once every 2 weeks. So we'll have to watch this space. Very very difficult to say who's going to be a winner and what is going to be adapted. But one thing is for sure, that this is a space that is going to do phenomenally well, because obesity is a pandemic across the world. There are so many ill effects that are that is there, and I think a lot of people will try GLP-1 in at least in India once the price declines, when the generics are available sometime later this year. So in short, not possible to answer this question over a 2-3 year time horizon. Short term, I think injectables will do well because the pills are not yet as good in terms of the results that they provide in terms of weight loss. So next question is Shomodev. So in line with your thoughts shared today, is the advisory on shipping, shipbuilding still active and encouraged? I think shipping and shipbuilding is being actively tracked by the central government. My expectation is that we will see some announcements in the budget, but we'll have to wait and see how that plays out. And just to give a small data point, I think if you look at a company like Dredging Corporation of India, which has a market cap roughly of 4,000 crores, again, this is not a recommendation, uh, etc. But the government has said, has given 4,000 crores to a company whose market cap is 4,000 crores, right? So just goes to show the kind of interest or the kind of impetus that the government has, or the thought process that the government has. So definitely, I think shipping, shipbuilding, dredging, ports, all of this is going to be area that we should actively look at. The next question is from Pawan. Geospatial sector spending has slowed down. Do you think it's still a player? I don't think it has slowed down at all. I think the only space where it has slowed down a bit is the Jal Jeevan mission area. But geospatial is much bigger than that. There is a mandate for digital mapping of the top 100 cities in the country. That is just getting started. There is a you know there is a mandate of digital land records. So all of this is going to happen. It's going to take time, and the obviously the spending on the government side also is not very huge. They're not saying that here is 1,000 crores and you go ahead and do the digital mapping in 6 months. So it's going to be a sector where the implication is going to be very far-fetched. It's going to be there for very long, and over time it has to happen. 10 years back there was no Google Maps, or there were no maps in the car, right? Today it is there. So tomorrow, if you just Google and study about what DGPIN is, right? DGPIN is basically where you will get a pin code or a digital pin for your every address. So these are things which will take place over the next 5 to 10 years, uh, and the overall addressable market in this could be very large, but it's a small sector. It's not going to become a huge sector like IT or banking or something like that. It's a small sector, small players, and as and when it really picks up, there may be a couple of entrants which will come in also. Uh, Prashant, can you start a monthly newsletter? How you see macro, where the government in a consumption basket out? Yeah, actually do that. If you see, I actually do a monthly video where I cover most of these things. I've been doing it. I used to do it in between. I had stopped doing it because I became lazy. Now I have stopped being lazy, and I have started doing it once more. Last few months I've done it. This month I didn't do it because I knew that I'll do this webinar, and excuse me, I'll keep doing this. One of the reasons why I'm doing this video nowadays is a lot of the younger generation, they keep telling me that they don't want to read. Uh, they might as well watch a video. So what I do is I write it out on the Substack, on the blog, and I also make a video of it, because people in my generation, we like to read and write, but that's the way it is. So yes, I mean, I've been doing it, and definitely I'll do more of it. Ankit Singh, your question is, in present geopolitical setup, isn't it better to play just dredging as a sector, not shipping as a whole? I don't think so. I mean, I think shipping, dredging, ports, all of this, shipbuilding, all of this is going to be important consideration for our country. So, for example, if you just study about Indian Navy operations in the Indian Ocean, it's something that is very intriguing. What we do, how much of water space Indian Navy needs to cover, uh, and my guess is that shipbuilding, both defense as well as maritime, is going to continue. It's going to get more focus, I would say, rather. Ports are already in focus to an extent, but I think if inland waterways at least gets a boost up, then it's going to be then it's going to have a ripple of effect. Shipbuilding is considered one of the mother industries, right? What that means is it has very large spillover effects into other ancillary industries in manufacturing. So I think the government, there's a definite possibility that the government is going to focus on it. And going by the track record of the government, what we've seen is they tend to look at a particular sector, boost it for a few years, 3, 4, 5 years, and then sort of slowly take their foot off the pedal from there and move on to something else. So if you see, they initially started with defense, then they started defense, and I think the first was highways, airports. Now that has gone slightly into the back burner. Railways came in next, defense came in. Now I think is the time for probably more of shipbuilding, shipping, ports, etc. It's possibility, and of course maybe some amount of focus on nuclear power and things like that. Okay, we already spent an hour and a half. If we have no more questions, then we can close for today. Let me see if there is any last question. Apparently, okay, this is Sunny, you've raised your hand once more. Yeah, so go ahead, please ask your question. And anyone else, if you have any more questions, just put in the chat box and then we can continue. Sunny, you can ask your question. Please unmute yourself.
Hi sir, what about the solar sector? Module, lots of news come in overcapacity in solar module, etc., etc.
Good question. So, my sense is that we will have problems with solar, and the reason I say that is because what is happening is that the connectivity of these solar plants to the grid is where the bottleneck is, and one of the main reasons is that solar is intermittent power, right? You're getting it only when the sun is up, and there is not enough storage capacity being built today with the solar plants. So I think one of the challenges that we saw in last year, I think, if I remember correctly, it was in Spain, right? Spain or Portugal, I think Spain, where there was a large grid failure because of renewables. So that is a definite challenge, and till we see a lot more of storage systems coming in place, I think solar is going to probably go a bit slow. That's my sense. We'll have to keep tracking and seeing how it goes. The part of solar which probably is going to do well is rooftop solar. I at least data wise, I am seeing a lot more adoption because the government subsidy has come in the last budget. So a lot more of adoption of rooftop solar that is happening currently in India. So that's one good part. In the solar theme, if I may call it, the energy storage, the battery storage is is probably the place to look at. Okay. The next question is from Sanjeev. Is it a good bet to buy into unlisted NSE shares? I have no clue. I don't look at unlisted shares simply because there is so much to do in the listed space where there is so much transparency. You get results every 3 months. You get management doing con calls. You get information. Why should I break my head and look at unlisted plays? Listed ही संभाला नहीं जा रहा है, unlisted में घुसने का क्या जरूरत है? It is not that NSE is doing something earth shattering. It has some new technology that no one else has that needs to be bought. It's a stock exchange. We have BSE, we have MCX to play exchanges if you want. MCX has done phenomenally well over the last few years. I personally if somebody buys into NSE unlisted, you might get a pop, you might not get a pop. There are so many cases where people lost their money buying unlisted, and then when it got listed, it listed at a discount. So I don't want to get into so much complexities in life. Life is anyway fairly complicated. Let's keep it simple. There are 5,500 companies listed on the BSE. If you even focus on the top 750 or top 1,000 companies, right, you will have enough to do, enough opportunities. We can focus on that and try to make money. Okay, with that, maybe that was the last question. We spent about an hour and a half. Thank you all for being patiently, listening to this. And as always, feel free to drop in a mail uh, to our email ID, and we'll do this once more at the end of the next quarter. And I'll keep posting, stuff that I read about and that I like on my blog and on Twitter and LinkedIn, if you're following me there. Thank you. Thanks once more.